It's Sunday, the 28th of October 2018. I wanted to talk about the Australian share market, the ASX 200 index, and some of the constituent stocks, and just my sort of feelings there. Haven't done a sort of a separate video on this for a while, but I have mentioned a few times that I don't see considerable upside for the Australian share market in the near term, mainly because a lot of the largest companies are under pressure in a lot of their individual business sectors. So this is a 10-year chart or more of the ASX 200, and I've drawn some of the trends that I've had in place for quite a long time, and what I think might be happening now. So you can see here that we've definitively gone below the trend that we've been in since early 2016, similar to the US share market if you have a look at the other video I've put up today. And that's, we've broken down from that trend, and now the question is where to. And since this bear market low 2009, we've had a couple of similar sort of corrections that I think might be what we might be having again. So in 2011 we had this move from down to about 1,000 points. So that seems to be sort of the magic number where that we get these retracements. You can see here that the move, this one went on a little bit longer. The initial move was similar, and then it had a slight sort of dip again below that 5,000 level. The 5,000 sort of been a key oscillating point for the last 10 years as well. So that's another key level. But then we've got this broader main trend since the low as well, where we've had, each of those bottoms has been at this lower trend line. I can think there's a considerable chance that we end up nearish to this level. So that's another 300 points lower, which would be, probably 6 or 7% lower. And that would sort of correspond with this move, a repeat of these moves. So that's sort of where I'm thinking the broader index goes. And when I hear people sort of say, oh, the Australian share market hasn't risen that much, so I won't fall. A lot of the stocks that make up the broader ASX 200 are not good value and are in sectors that are under pressure. And the banks would be the main one there. And the sort of the question is whether these are foretelling broader problems for the Australian share market or the Australian economy. ASX, the CBA is down probably more than 30% from the highs now in 2015, and has broken below this key zone around $70-$75, and now looks to be heading toward the next lower zone, which is sort of corresponds with the peaks in 2008 and 2010. Right, that's sort of around the $60 level, and it looks like it's going to get there because there's just no signs of strength coming into this chart. And a lot of the other banking stocks are similar. Westpac, I think, is trading at 5-year lows now, sort of really fallen below this critical sort of support level there in Westpac's case around that sort of $27, and it's fallen below there, and just not a lot below, not a lot of support anywhere near. So you've got to wonder at what point these stocks start to come under more pressure. And the market, I think, is predicting that the effects of that Royal Commission, for example, are going to start being seen in bank earnings and the dividends they're paying. People are sort of a bit unaware of what's going on here, I think, but it's usually price runs ahead of fundamentals, or at least the earnings are delayed. ANZ, again, is a little bit stronger, probably, it's still above its 2016 lows, but still trading, no higher than it was 5 or 6 years ago. So all these banking stocks, there's such a large proportion of the market. There's about 20% of the ASX 200 in those 4 stocks. And then obviously you've got the big mining companies. BHP and Rio have been doing reasonably well and are still probably some of the strongest stocks in the top 20 this year. But, this chart, the BHP chart, looks a little bit weak, I think, and is struggling to go higher here, definitely. And I think a lot of the commodities, the oil price has done very well, and I think that may have helped BHP shares for the last 6 months. But the oil price is starting to turn over a little bit. Base metals are okay but flat. Iron ore is doing pretty well, but The question is whether that iron ore price starts to turn over, and I think so that's been holding up BHP, and Rio in particular I think is probably an even stronger chart. But those two stocks on their own I don't think can really pull the market higher, particularly in an environment of trade wars, and it's unlikely that commodity prices will do very well in that environment. Rio sort of potentially forming a bit of a head and shoulders top there, I think around that 87 the high, and maybe a neckline sort of in this 70 zone. So not sure what the fundamentals for iron ore are at the moment, but the price has held up fairly well. So that's, but it's other stocks that are sort of outside the banking and commodities sectors. CSL's probably been the one that's really been pulling, and this is I guess a trend in the healthcare stocks in particular. CSL shares were up 50 to 70% at the highs at one point this year, from January to its high in 230 there, and that's in my mind pretty ridiculous. CSL is a very good company, but it's clearly showing a bit of a bubble forming here, and that's really come undone in the last 6 months, or the last 3 months in particular. And you see that the key sign is when you have these trends, and a nice little trend there, stocks trending very well, but then it goes goes vertical at that next sort of level of and the fundamentals don't change significantly a company of this size to justify such a price increase. I think CSL is now about the 5th most highly valued stock in the ASX, but it's clearly being crunched there, and it was showing a bubble characteristics, which is sort of there's been a bubble in those healthcare stocks. So that's, I don't see what's going to drive this market higher in the next 3 to 6 months, particularly with pressure from overseas. There's nothing really to say that I don't think commodity prices are going to do that well in the next short term anyway, and the domestic economy seems to be rolling over as well, which I think is evidenced by those banking stocks. So owning the ASX 200 at this point is kind of a bit pointless to me. Like I'm not really sure what's going to pull it higher. I think people talk about the index as if it's some sort of just traded commodity in itself. It's not. It's a made up of all those other companies, and none of them, like in that 50 or 60% of the stocks in the is it 50%, 60% of the ASX 200 is in those top 20. So I don't see oil prices as well. So companies like Origin, Santos, Woodside are in that those top 20 or 50 stocks. Oil price has done pretty well, and that's been probably the best sector to be in the last 6 months. But it's not. It's starting to turn over, and I think, and again, in an environment of sort of trade wars and general economic weakness in a lot of countries in the world at the moment, US being sort of the outlier. Generally, that's not very supportive for oil prices. So I don't see a major tailwind there that's going to drag. So a lot of those, the things that have pushed the share market higher in the past, those sectors are really, it's hard to find which one's going to be a winner and drive this thing higher. So I think in the short term, we're just going to be driven by offshore moves as well, and that's US share market turning over, as I said in the other video I put up today. So I think the ASX 200, I don't see a reason to own it at these levels with no clear catalyst and no clear sectors that look like they're going to outperform in the short term. The other one was Telstra. Telstra shares have obviously been struggling a lot, and the telco sector in general I don't think is a great investment at this point. Telstra, has come up reasonably from the lows, but still not a great. I don't think there's going to be a rush back into Telstra shares. I don't know what the catalyst is for that stock to turn around either, but it's not going to be enough to pull the broader market higher anyway. The telco sector is a relatively small proportion of the market. Consumer staple stocks like Woolworths or Wesfarmers, I don't think, again, they're pretty sort of flat sectors. Woolworths has been a pretty good stock for the last 18 months after it bottomed, but it's come back up to that level. I think I talked about this in a video a few months ago, that key level, the breakdown level, high volume point, and that sort of a textbook move back up to there and never filled that gap. But Woolworths isn't going to come and save the market anytime soon. It's just relatively reliable, but there's no major growth going to be happening there. Wesfarmers had been a stock that has done very well this year also. I think that's to do with their divesting coals. But even then, they're struggling. You can see here there's this 200. This is a 200-day moving average on all these charts, and I'm not a particularly huge fan of the 200-day moving average from a trading point of view, but it is a good indicator of trend change, and probably the one sort of medium longer term trend indicator that a lot of chartists use. On all these charts, the ASX 200 chart, the individual company charts, the S&P 500, the 200-day moving average is coming into play on a lot of the key stocks that make up these indices. And to my mind, it looks like it's breaking for the most part on a lot of those charts. So I'm not, don't see what's going to be pulling the Australian market higher, and I'm not, but maybe the Australian dollar falling more gives a bit of a tailwind to commodity prices, but in general, commodity prices are weakening in US dollars too. So I don't know if that's going to be enough to boost offshore earning, US dollar based earnings. So I think my money is on a move back toward this 5,300 sort of level. Potentially by the end of the year, the strength of this decline on the ASX. I mean, even on Thursday night Australian time, the US market bounced quite heavily, about 2%, and I know there was a lot of people thinking the ASX would repeat that move, and have a 1 or 2% move up higher, but it closed lower, or closed flat on the day, and probably preempting the move on Wall Street on Friday when that went down another 1.5 to 2%. So there's just not a lot of signs of strength here, I guess, to sum it up. But so I don't have any exposure to the ASX 200 at the moment, and I don't plan on maybe if we can get toward this 5,000 sort of 5,300 level, it might be worth moving back some allocation in there and finding some of those better opportunities. Some of these companies are good companies, but there's just not a lot of growth there, and that's been the story. Why the ASX 200 is still 15-20% below the highs in 2007. There's just not a lot of great companies in there. The other one, you had companies like AMP, which is absolutely slaughtered this week, and that's again, I think that's sort of tied to the Royal Commission. I know that Royal Commission into the financial sector is not over yet, and some of the findings from that will be impact earnings of some of these companies for a long time. So it's not just a short-term thing that they're going to be able to rush off and go back to sort of loose lending practices. And so I think all of that is a major change and not just a short-term effect. So I'd be wary in some of those banking stocks in particular. And I've said in before that I don't think the housing market is in great shape either. And you've seen Sydney and Melbourne house prices down sort of 6 or 7% in the last 9 months, and those moves seem to be accelerating, and the clearance rate seems to be dropping more and more heavily. So whether this is all sort of lining up as a fairly bearish stance in the short term at least. So I'm not sure what's going to be the driver higher, and I'll continue to sort of avoid the ASX 200 in a broad sense and many of those large cap stocks.